Now, let's go to another question. Okay. Again, we are applying the principles. So let's go to another question. I want to bring you up with another question here. This II question here for 5 marks. This one, Zeus Limited. Let's look at that. Pay attention to the context, and we are going to be referring to the principles, then you solve the question. We refer to the principles, then you solve the question. So again, keeping in mind the choice of words that the examiner can use. What did we say? Bought, purchased, acquired, financial assets. Sold, issue, raise, finance, financial liability, or equity, depending on the context. So let's go to Zeus and let's see what is coming here. The requirement is pretty simple here. The examiner said, recommend to the directors of Zeus Limited how the above transaction should be accounted for in the financial statement for the year ended 31st December 2020 in accordance with relevant international financial reporting standards. In accordance with relevant financial reporting standards. So here, in the context of this question, recommend. Now, please understand the verbs that the examiner is using. If you look at the question we solved earlier on, Asamankese, the examiner said, how much should be recognized? So it means you do calculation and go away. How much should be recognized? You just do calculation and go away. But in the question relating to Zeus, the examiner is saying that recommend. Now, anytime there is something like recommend, it means you got to write some English, okay? Or let me put it in a simpler way. You write some notes. You have to explain to them what the heck is going on, because if you are recommending, and I believe that in case you are not aware, we've covered the various verbs that the examiner is going to be using in the exam hall and what you do when such verb is stated by the examiner. In case you have not watched that video, you can check the How To channel and you'll be able to watch that video as well on our channel. But here, it means you have to write some English, explain what is going on, and then you do the calculation on top of it. So let's see what we got here. Now, if the year ended is 31st December, meaning the year starts on where? 1st January. So let's go. On 1st January 2020, which is the beginning of the year, Zeus raised finance. Did you hear that? Zeus raised finance by issuing. Okay. Raised finance by issuing. Raised finance by issuing. Okay, so where are we in our principle? We are on the liability side or equity side, because we are seeing the word raise finance and issue coming in. So this is likely to be a financial liability or equity instrument. Again, that's the principle. If you read a question and the principle doesn't click like that, and you're like, oh, anytime I take the question, I don't know what to do, go back to the principle, go back to the basics. So by issuing a 2-year deeply discounted 2% bond with a nominal value of 20,000, that is issued at a discount of 5% and is redeemable. Okay. So let's go back to the rule again. So we said that once they have issued a certain instrument, we have to ask ourselves the question, does the entity have an obligation to repay? If no, it's an equity instrument. If yes, it's a financial liability. So look at the context of the question in relation to Zeus. We are being told that the entity has issued a bond, but the bond is redeemable at a premium. Ooh. So since it is redeemable, obviously it means we are dealing with a financial liability. Why? Because it is redeemable. So it's a financial liability. If it is a financial liability, how are we to recognize it? So we go, initial measurement. Look at the principle we stated. We said for financial liability, it is recognized at fair value less transaction cost. It is recognized at fair value less transaction cost. It is recognized at fair value less transaction cost. Principal. Then on subsequent measurement, you carry it at amortized cost. Principal. So let's go. So we are told that it's a 2% bond. So in the context of this question, it means our coupon rate is 2%. Okay? The coupon rate is 2%. That is the interest payable or interest paid annually. So every year, this is how much they will pay, Zeus will pay to the bondholders. 2%, that's the coupon rate. Now, we are told that it was issued at a discount of 5%. What does that mean? It means Zeus Limited did not receive the total face value of 20,000. They received 95% of the 20,000. So let's go to initial measurement. Initial measurement at the beginning of the year, 1st January 2020 in the context of this question here. So let's go pull up our currency sign. Here we can just work in Ghana cedi like that and then go away in the context of the question. So what is the fair value here that we will recognize? They said they issued it as a discount of 5%. So we take 95% of the face value, which in this question is 20,000 Ghana cedi. So 95% of 20,000, what do we have? I'm getting 19,000 Ghana cedi. Okay, that is the amount at which they will carry. But don't forget, because the coupon rate is 2%, and the coupon rate will always apply on the nominal value of the bond. So annual interest that is paid will be 2% of the coupon rate, which is of the nominal value, which is 20,000. Okay, of the nominal value, which is 20,000. So what do we have? 0.02 by 20,000, and that gives us 400. So every year, the entity will pay 400 Ghana cedis to the bond holders. Every year, the entity will pay 400 Ghana cedi to the bondholders. That is the annual interest paid. Let's continue to read. There were no issue costs. Okay, so in this question, there was no issue cost. So it means that the bond, the initial measurement becomes the 19,000 because there was no issue cost. If there was an issue cost, we would have subtracted it, because remember the principle. What does the principle say? The principle states that financial liability is recognized at fair value less transaction cost. Here, there is no transaction cost. You see, I keep just coming back to the principle because that's all standards are about. You can solve 7 billion questions. It's just about the standards generally in that particular case. And that is something that you need to understand very well in that regard. So if this is the initial measurement, let's look at what is happening on the subsequent measurement, which is the year ended. So at 31st December 2020, what are we going to have? Remember, it is carried at amortized cost. So we bring in the balance brought forward. We bring in the interest. We bring in the interest. So we bring in the interest payable. If you want, that will be the interest effective rate. Then we bring in the interest or cash paid here. Then we can get a balance brought down. Then we slash in our currency sign here. Now stay with me. Our year ended is 31st December. So we bring it up. 31st 12, 2020. We bring in the initial value we got, 19,000. Now remember, the effective interest rate here is 10%. Okay, the bond has an effective interest rate of 10%. So that 10% is what will come here, 10%. So we take 10% of 19,000, and that is 1,009. And then the cash paid, remember we said that is the annual amount they will pay, the 400. We subtract that, and that gives us the carrying amount. So 19,000 plus 1,009 minus 400, boom, that gives us 20,500 at 30. 20,500. So the interest payable, which is the effective interest rate, that is what goes to the P&L account, not the coupon rate. The effective rate is what goes to the P&L account, not the coupon rate. Not the coupon rate. So once we are done with this, we can extract the financial statement. So profit or loss, it's an extract again for the year ended, whatever the heck, 31st 12, 2020. Okay, 31st 12, 2020. In that case, boom. So what will we bring? Now, look at the flip side. In Asaman Kese, because it was an asset, we brought it as finance income. But here, because it's a liability, we will bring it as finance cost. Okay, finance cost. And that is where the effective rate will come in, and that's the 1,009. So again, assuming we are preparing an extract financial statement and they had recorded 400 in the P&L account, then when we come, the excess amount, which in this case will be 1,500, is what we will add to finance cost. Again, it's an extract, so you leave it like that. Okay, it's an extract. You can put it in brackets or leave it like that. It's an extract. Then we go to the statement of financial position. Go to statements of financial position. Also an extract after that year. Now, this is a liability. So generally, it will be under liability, but what kind of liability it is? Let's see. We are told that they issue a 2-year bond. Okay, so it means they will redeem it in the next 6 months. So really, this will be under current liability. So under current liability, we'll just bring in the financial liability. Okay, assuming the redemption date is more than 1 year, then it will be under non-current liability. But because this one is a 2-year bond, 1 year has already elapsed, so we have just 1 year to go. So the carrying amount which we calculated above, 20,500. This is the answer to the question. But like I said earlier, you would have to speak some English. You have to write some notes explaining how we did what we did.